Okay, so that answers the second question. Is the company over or undervalued? The answer is currently the shares are undervalued. But does it mean that it's a good time to enter right now? Remember, in the short term, stock prices are driven not by logic, they are driven by emotions. Okay, so whenever the market is pessimistic, is bearish, even if the stock is cheap, guess what? Cheap can get cheaper, low can get lower. At the same time, when the market is bullish on the stock, when they're optimistic on something like Amazon, right? Guess what? Even if the shares are expensive, they're overvalued, expensive can become even more expensive, higher can become even higher. So to decide if it's a good time to enter, we have to look at the charts to determine the price action, to look at the emotions that are driving the stock on a day-to-day basis. So let's take a look at that right now. So now we've analyzed the fundamentals of the business, we need to consult the charts. Because remember that in the short term, stock prices are not driven by fundamentals or logic. They're driven by the emotions in the market, bullishness and bearishness. And so technical analysis is a study of the emotions that drive the price in the short term. And if you want to fine-tune your entry, it's really important to understand what the charts are telling you in terms of, again, the emotions that are driving the stock. So the first thing is, well, let me just remove these lines first. So you can see that Facebook was on a very nice uptrend. It made a high of 218.62. And when it announced earnings before the market opened, the moment the market opened, it gapped down from 218 to a low of about 173. And it's currently at 174.89 right there. So again, the question is, hey, you know what? Is that a strong level of support? Is it likely to go lower, and how much lower could it go? All right, and is it a safe time to enter at this level? So let's break it down. Well, the first thing is to ask this question. Okay, why did the price gap down to 174? Did it happen by chance? Nothing happens by chance in life. Everything happens for a reason. So if you look closer, you notice that this level is pretty significant because it is a significant support and resistance level. Okay, if you were to zoom in and you take a look over here, boom, this is a significant level because this was a previous resistance, and resistance. All right, this was a resistance. It broke out and became support, 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 support. So this is a multiple support level, saying that there are many buyers waiting at that level to support the price. So it gapped down right to the support level. So this is a strong support. But again, it could always break the support. Okay? And if it breaks the support, where is it likely to go? Where's the next level of support for this stock based on historical demand and supply patterns, right? And the next level of support I can see would be somewhere here. That's the next level of support. Because you can see this was resistance, resistance, resistance. It broke out, and again, it found support over here, support over here. Okay. So this 155.98 is the next level of support. So if it breaks 172, that's the next target, 155. And if it breaks 155, where can we go then? I would say the next level of support would probably be here, right? There was previous resistance, broke out, turned support, turned support. Next level is 144. I would say it's unlikely to go below 144. All right, so 172, next level 155, next level 144. Right? The other thing which is really interesting is to notice that this level right now where we are is a Fibonacci level. Okay? If you take this as the beginning of the impulsive wave A to B, right? So it moves from A to B and to C. This is a Fibonacci level. So let's check it out. Let me use the Fibonacci tool over here. So click A to B. There we go. Okay, let me redraw that without those lines. Hold on, let me just redraw that. Wow. Okay. So A to B. Boom. So you can see that currently at this price, we are exactly at the 61.8% retracement level. So 61.8% is a significant support level as well. Now, if you look at its previous retracement from here, this is A to B, right? So A, B, C, right? It reached again 50% to 61.8%. So again, it was a very close Fibonacci level. This ABC, again, at a Fibonacci level. So this is a very strong support level. All right, so the question is, if this is a support level, can we enter right now? Well, based on the charts, no, because we want to see a bullish candlestick reversal pattern, or we want to see a bullish sign from the candlestick pattern. And right now, what you see over here is known as a bullish engulfing candle pattern, which is a bearish pattern, because this bearish candle engulfs the bullish candle. So before I enter, I would like to see that first of all, the price should break above the high of this candle. So the high of this candle is, let's take a look here. High is 180.183. So I'm going to put a level here. Somewhere there. Okay. There you go. So I want to see the price get above the high of 180 before considering entry. That's number one. Number two, I want to see a bullish candlestick pattern. So for example, it could be a bullish pin bar, it could be a bullish engulfing pattern, or a one white soldier pattern. So I definitely want to see a bullish reversal pattern, and support is being held before I take my initial entry. Now we have analyzed the fundamentals of the company. So based on fundamentals, it's a really good business. And based on fundamentals, it is undervalued. But based on technical analysis, it is not time to enter yet, because although it's at a strong support, we don't have a bullish candlestick reversal pattern. So the question people always ask me is, Adam, what's more important, the fundamentals or the technical analysis? Well, it all depends on whether you're an investor, a long-term investor, or short-term trader. Okay, so let me give you an example. See, long-term investing is when you believe in a company and you want to get married to the company, right? Through good times and bad. Through sickness and in health, you're going to hold on through the ups and downs because you know that in the long run, the company will do well. That is the investor's perspective. So investors tend to focus very much on the fundamentals of the company. And timing the entry is secondary, okay? But if you're a short-term trader, then you want to focus more on the technical analysis because you want to get in and out really, really fast. So you focus on, do I have a good risk-to-return ratio? And I'd love to give an example. Here's a metaphor. So long-term investment is kind of like you want to get married to the stock, right? You want a long-term commitment. Short-term trading is kind of like a one-night stand. So let me ask you a question. If you're dating a girl or dating a guy, which is more important? The fundamentals of the person or the technicals of the person? Okay, what do I mean? So fundamentals means the person has got a good character, has got a good heart, is well educated, it's got a good job, right? That's the fundamentals, right? So technicals would be the person looks sexy, looks attractive, is hot, it's horny. Okay. What's more important? It depends, right? If you don't look for someone for a long-term commitment, then fundamentals are more important. The character, the person's education, for example, that's important, right? And in the short term, if the person's a bit moody, it's fine. You're holding through the ups and downs. You're willing to hold for the long run. But if you're in it for a one-night stand, then fundamentals are not important. Imagine you want to go have a girl or guy and say, you know what, let's go to my room. Before we go to my room, I want to check your university degree. I like to check your qualifications. I like you to, are you a good person? You don't care, right? As long as the person's sexy, it's attractive, you go for it, right? So same thing in the markets. For long-term investment, fundamentals are more important. It must be a good business, okay? You hold it through the ups and downs. If it drops, you can buy some more because you hold it through the downs, right? But as a short-term trader, you've got no loyalty to the company. You don't care about the fundamentals. It's all about the one-night stand. Get in fast, get out fast, make some quick money, and that's it. So for long-term investment, again, like I said, we focus on the fundamentals. So Facebook is a good business, and it makes a good long-term investment if you want to invest in a company. But to help us to time our entry, again, we could use the charts to help us to make good decisions. And what you could do is what we call dollar cost averaging. So dollar cost averaging means that if you have 10,000 to invest, do not invest all of it at one time. Invest maybe a third, 3,000 at this price right now. If it breaks the support, goes to the next support at 155, buy another 3,000. If it breaks and goes to 130, buy again. So you average down the price. And you can do that if you're having a long-term perspective. And for investments, you do not have a stop loss. Okay, there's no protection because you believe in the company, you know that it won't die, you'll come back one day. Okay. But for short-term trading, you always have to put a stop loss. You must always use protection. It's kind of like, in a marriage, you don't use protection, right? Well, at least I don't. Okay. But if you go for a one-night stand, which I don't in real life, okay, but in the markets, I do one-night stands all the time. You go for a one-night stand, you got to put protection, just in case, all right? So you have a stop loss, so you define your risk as 1R. So you always risk 1R to make 2R or 3R. And if it hits your stop loss, you get out, wait for the next bullish pattern, enter again, stop loss again, and you keep doing that until you get a winning trade. So remember, in short-term trading, your win rate's kind of like 60% win, 40% loss. When you lose 1R or risk, you lose like $3. When you win $6. And in the long run, you make money as long as you're right about half the time. Okay, with a stop loss. So it's a different perspective. All right, so if you're an investor and you believe in the long-term fundamentals of the company, you want to have a long-term commitment, then what you can do is you can buy right now at 174.89 because you know that the intrinsic value is about $200 in the worst case scenario, and you're buying it while it's undervalued. But bear in mind that, again, cheap can become cheaper. So if you buy right now, right, if it breaks below to 155, you can add more shares to average down your cost. We call that dollar cost averaging. And again, if it breaks further down to 144, you can again average down. So do not invest everything at one go. Split it up into 3 or 4 investments to average down your cost. And you know that in the long run, okay, in 2, 3, 4 years, you're definitely going to make money on this stock because it is a good business. It's got a wide economic moat. It's a consistent performer. All right, so that's for long-term investment perspective. Now, if you're a short-term trader and you're in it for a one-night stand, then you do not buy it now yet. You have to wait for some kind of bullish candlestick pattern. Again, you're waiting for like a bullish engulfing pattern or a bullish pin bar. All right, and you can watch these on my videos on a powerful candlestick pattern. So, for example, if you see if you see a bullish candlestick pattern, and you can say, okay, I'm going to buy at 180.18, right? Wait for it to break the high of this candle. So I'm going to buy at 180. And if you're a short-term trader, always use protection, right? Remember that. So you may want to put a stop loss at, for example, 171, just below the low of this candle. So put a stop loss at 171, for example. So if you buy at 180 with a stop loss at 171, what is your risk per share? Your 1R risk would be about $9. So you're risking $9. And if it reaches the high over here, you're making about $40. All right, so you're risking $9 to make $40. That's risking 1 to make about 4. 1:4. So that's a pretty good trade, right? So again, as a short-term trader, once you enter, be prepared to either win, $40 or to lose $9. Now, if it hits your stop loss at $9, you got to get out. You have to honor your stop loss, cut loss, get out at $9. And if it breaks and it goes down, wait for the next support at say 155. And if it bounces off with another candlestick pattern, again, re-enter at 155, stop loss at 150, profit target higher. So you keep doing that, and you're risking 1 to make 3, 1 to make 2, 1 to make 4. And as long as you're right half the time, you're very profitable. And that's the concept behind trading, right? It's a numbers game. So I hope that with that, you understand how to tackle investments and trades like the ones in Facebook. This is Adam Khoo. If you've got questions, leave a comment below. I'd love to hear from you, and thank you for watching. If you like this video, click on the subscribe button to get my latest video updates every month or every week. If you want to check out my live trading courses in Asia or check out my online investing and trading classes, do check out wealthacademyglobal.com for my live classes in Asia or piranhaprofits.com for my online professional stock and forex trading classes. This is Adam Khoo, and I'll see you guys soon. May the markets be with you.